They called it the greatest wealth transfer in European history. 400 billion euros, gone. But here's what they won't tell you. It didn't disappear. It moved, deliberately, systematically. And the same institutions that shape this system are managing your retirement right now. By the time this video ends, you'll see the invisible architecture that turns your future into someone else's profit. The question isn't whether your pension is at risk. The question is, do you understand who's already decided how much of it you'll actually see? Stay with me. What comes next will change how you see every retirement statement, every market downturn, every government reform for the rest of your life. Let's start with something most people believe, but almost no one questions. European pension systems are supposed to be among the safest in the world. 3 pillars: state security, occupational stability. It sounds reassuring. It sounds diversified. But here's the part they leave out. Now, those 3 pillars don't distribute risk equally. They concentrate it. And they concentrate it precisely where you won't notice until it's too late. The first pillar, state pensions, operates on a simple promise. You pay in during your working years, the government pays out during retirement. Except the promise is built on a demographic assumption that no longer exists. When these systems were designed, there were 5 workers supporting every retiree. Today, in countries like Italy and Germany, that ratio is approaching 2 to 1. But instead of admitting the system is structurally insolvent, governments adjust the variables. They raise the retirement age, they change inflation indexing, they redefine what counts as a full pension. Each adjustment is framed as a responsible reform. Each reform transfers risk from the state to you. The second pillar, occupational pensions, sounds even better. Your employer contributes. The fund grows. You retire with dignity. Except most of these funds aren't managed by your employer anymore. They're managed by external asset managers operating under mandates you've never read. And here's where it gets interesting. Those fees don't disappear when the fund loses money. A pension fund can drop 20% in value, and the management company still collects its annual fee. The incentive isn't to protect your retirement. The incentive is to keep the fund large enough to justify the fee. The third pillar, private pensions, is where the system tells you that you're finally in control. You choose your investments. You decide your risk tolerance. Except you're not really in control. You're participating in a market where central bank policies can erase a decade of savings overnight, where geopolitical events you'll never predict determine whether you retire at 65 or 75. You're told it's empowerment. It's actually exposure. And the difference between those 2 words is the difference between financial security and financial precarity. Now, here's the part that should make you pause. Those 400 billion euros didn't evaporate in a single crash. They eroded across 2 decades of low returns, high fees, and structural changes that almost no one noticed because they happened so gradually. When a pension fund announces it's shifting from a defined benefit plan to a defined contribution plan, it sounds technical, administrative. But what it actually means is this. The company is no longer promising you a specific retirement income. They're promising to contribute a specific amount while you work. What happens to that money afterward? That's your problem now. The risk has been transferred. Legally, quietly, completely. And this is where the 400 billion becomes visible. Because when you multiply that transfer across millions of workers, across dozens of countries, across 2 decades of policy changes, you don't get a crisis. You get a reallocation. A slow, steady flow of obligation from institutions to individuals. The money didn't disappear. It was never yours to begin with. It was a promise, and promises can be restructured. But who benefits when promises are restructured? That's the question no one asks, because the answer implicates everyone in power. Let's talk about asset managers. The largest global asset managers control trillions in retirement savings, and their business model is extraordinarily simple. They charge a percentage of assets under management, regardless of performance. Think about that structure for a moment. A fund with 100 billion euros in assets charges, say, 0.5% annually. That's 500 million euros in fees every year. Even if the fund loses 10 billion in value, the management fee still generates 450 million. The incentive isn't to maximize your returns. The incentive is to maximize assets under management. It's not corruption, it's structural alignment. When the rules are written by people who profit from the rules, you don't get fraud, you get optimization. And optimization at scale is indistinguishable from extraction. And asset managers aren't even the biggest beneficiaries, because the real winner is the institution that controls the rules themselves, governments. Let's be very clear about what happens when a pension system underperforms. The state doesn't absorb the loss, it adjusts the expectations. Retirement age goes from 65 to 67, then to 68. Pension payouts are indexed to inflation, but the inflation metric is changed to exclude volatile items like energy and food, which means the number goes up, but your purchasing power stays flat. Every adjustment is defended as fiscal responsibility, but the outcome is consistently the same. The government promises less and pays later. When a government raises the retirement age by 2 years, it's not just delaying payments, It's eliminating them entirely for everyone who dies before reaching the new threshold. They'll pay into the system their entire working lives and receive nothing. That's not a side effect. That's a feature. It's how the system balances its books. Finally, let's look at corporations. The shift from defined benefit pensions to defined contribution plans is one of the largest wealth transfers in modern history, and it happened so quietly, most workers didn't even notice. A defined benefit plan promises you a specific income in retirement. The company bears the investment risk. A defined contribution plan just promises to put money in while you work. The risk is now entirely yours. It was a transfer of obligation, done quietly and legally, from corporations to you. The system is no longer designed to honor commitments. It's designed to delay reckoning. And every delay transfers more obligation from the state and from corporations to you, the individual. Understanding this isn't meant to make you panic. It's meant to make you aware. The first step to navigating a system is understanding how it truly works. Did you know corporations have found a way to completely sidestep their pension promises? Unlike governments, they don't just adjust the terms, they completely restructure their obligations. Over the last 30 years, companies all over Europe have been quietly closing their old pension plans, the ones that guaranteed you a specific income in retirement. Instead, they've rolled out new plans where they only promise to contribute a set amount while you work. After that, the money is your problem. The investment risk is yours. The risk of outliving your savings is yours. The risk of a market crash, all yours. The company's responsibility ends the second they make their payment. For them, it's brilliant. They've turned an unpredictable long-term debt into a simple fixed expense. Their balance sheets look better, their credit ratings go up, and their stock price soars. And who pays for this financial magic trick? The workers. People like you are now forced to navigate complex financial markets they don't understand, facing risks they can't control. Corporations will tell you this is all about giving you more flexibility and control. And sure, for a tiny slice of high-earning, financially savvy workers, that might be true. But for the vast majority of people, it's a catastrophic transfer of risk. Most of us aren't equipped to manage a 40-year investment strategy. We panic when the market drops and get greedy during bubbles. The financial industry knows this and profits from every single mistake we make. But it's not just corporations. This shift benefits a whole ecosystem. Asset managers charge fees, investment banks create complicated products, and consultants advise on strategy. Every layer of the financial system takes a slice of your retirement savings. So if companies are saving money and the entire financial industry is profiting, there's only one question left. Who's footing the bill? It's middle-income workers. The people who did everything right. They worked their whole lives, paid their dues, and trusted the system. And that system has quietly and legally siphoned away their future security. Think of Maria, a teacher in Spain. After 38 years of work, she expected a pension of 1,400 euros a month. She got 1,100. Why? 1,000 tiny, necessary reforms over the years. The retirement age was raised, the calculation method was changed. Each step chipped away at her pension, reducing it by over 20%. And she's one of millions. This isn't just about current retirees. Younger workers are entering a system that's even weaker. They're being told to save more, work longer, and accept far more uncertainty than their parents ever did. The social contract has been rewritten. Retirement is no longer a social right. It's an investment outcome. Let me ask you something, and I want you to be honest in the comments. Do you believe your pension system will actually pay you what it's promising right now? Type yes if you think you'll get it all, and no if you think the rules will change. Because here's the urgent part. The conditions that created this problem are getting worse. Interest rates are volatile, demographics are shifting, and governments lack the political courage to be honest about it. The system is designed to survive by transferring risk from institutions onto you. So, what can you do? First, understand that your pension is a projection, not a guarantee. Second, diversify your retirement income sources. Don't put all your eggs in one basket. Third, plan for the system to change. Assume you'll have to work longer for lower benefits. It's not pessimistic, it's realistic. And finally, financial literacy is no longer optional. You have to understand how this game is played, because the alternative is trusting a system that will prioritize itself over you every time. If this video opened your eyes, do 3 things for me. First, like this video to tell YouTube this information matters. Second, subscribe. I break down how these hidden systems work for healthcare, housing, and education too. You don't want to miss my next video where I'll reveal which European countries are most at risk for the next pension crisis. And third, share this with someone who needs to hear it. The biggest threat to your financial future isn't the market, it's the belief that the system is on your side. Thanks for watching, and I'll see you in the next one.